You're listening to the Financial Source podcast on YouTube.
Welcome back to the Financial Source podcast.
We're doing something a little different in this episode. We're in episode 4 of about a 100-part series designed to walk through macro fundamentals from the ground up.
Yeah, so if you're new to the world of economics, trading, or policy, this series is definitely built for you.
And this deep dive is called 8 Pillars of Market Movement.
Okay, 8 pillars. And this really tackles that frustration. I think every trader feels it at some point, right?
Oh, definitely. You see a setup, maybe a clean chart breakout, looks perfect, or you get good economic data, seems obvious what should happen.
And then it just falls apart, completely moves the wrong way.
Exactly. And the simple truth is the market rarely moves for just one single reason. It's usually a mix of drivers, and the focus is constantly shifting between them.
Understanding those shifts is so critical now. I mean, look at the shock we saw in 2021, 2022.
Right.
That long-held idea that bonds and stocks move opposite ways, it just evaporated.
Completely broke down. And the classic 60-40 portfolio, the one that's supposed to be stable, it got hammered. Huge drawdowns.
Yeah, it really shows how the underlying rules can just get rewritten overnight by these big forces.
It does. It's a perfect example. So today, what we want to do is break down that chaos. We're going to give you 8 core lenses, essentially, to help you interpret why the market's moving and, really crucially, figure out which lens, which driver is dominating the story today.
All right, let's unpack this. So 8 drivers, but thinking of them as lenses or tools. I like that. It's not about memorizing fixed rules because things change.
Exactly. The goal is to learn how to read the market's shifting script. So lens number 1, or pillar 1, global macro themes. Yep. These are the big overarching storylines. Think multi-year narratives that influence basically everything across all assets. It's like the background music of the financial world.
So not just a headline, but something bigger, more persistent.
Much bigger. Think about the global financial crisis back in '08. That set the tone for years.
Right. Low rates, QE.
Or the COVID pandemic in 2020, massive disruption. Or, these big inflation shocks we've seen, central bank tightening cycles. These are themes that define eras.
So if these themes are multi-year, how does someone trading on, say, a weekly or daily time frame actually spot one early enough before it's obvious to everyone?
That's the key question. It often comes down to seeing the change in central bank language or unexpected shifts in how different markets relate to each other, those correlations.
Okay.
If you miss the dominant theme, honestly, you're probably just trading noise. Like in 2021 when inflation clearly became the story.
Everything changed.
Everything. Suddenly, every piece of data, every central bank comment was viewed through that inflation lens. Spotting that shift early made predicting, or at least understanding, the Fed's next moves much, much easier. It simplifies everything else.
Got it. So the theme sets the stage. And right alongside that, you have pillar 2, monetary policy.
Yeah, this is where the market mood meets the central bank muscle, as you put it. You just can't ignore institutions like the Federal Reserve, the ECB, the RBA.
They control the taps, essentially. The flow of money, the cost of money.
And expectations. Crucially, expectations. Their power isn't just hiking or cutting short-term interest rates, so that's huge.
Right, there's QE and QT too.
Exactly. Quantitative easing pumps liquidity in, quantitative tightening pulls it out.
Right.
And when a central bank delivers what the market sees as a hawkish surprise...
Meaning they sound tougher on inflation, more likely to hike rates than expected.
Precisely. The reaction can be immediate and global.
Oh yeah, we see it all the time. A surprisingly hawkish Fed statement hits the wires and boom.
Dollar spikes, stocks often sell off, bond yields jump, all within minutes.
But hang on, doesn't the market sometimes just ignore the Fed or fight it? When does that happen?
It happens when the market loses faith in their guidance, when credibility is questioned. But generally speaking, the Fed's view on the economy, their outlook, that's the bedrock story the market prices off.
So if they signal rate cuts are coming?
The market starts pricing that in immediately. Capital moves based on expected returns. So even a subtle tweak, a single phrase change in a press conference about the future path of rates can shift billions in capital flows almost instantly.
Okay, so we've got the big themes and the central bank actions. Now we move to the things that pop up on the calendar every week, every month. Pillar 3, economic data.
Right. These are your scheduled catalysts. The events traders literally set alarms for. Employment reports, inflation numbers like CPI, GDP figures, retail sales.
The stuff that makes the screens flash red or green. But here's something that confuses people starting out, I think. Why does a really strong jobs report sometimes make the stock market fall? Shouldn't good news be good news?
Ah, yes. That's a classic, and the answer gets to a really critical nuance here. The market rarely trades the headline number itself.
It trades the surprise.
Exactly. It's all about the number relative to what was expected.
So if everyone expects, say, 150,000 new jobs and the report comes in right at 150K.
Market might barely react. It was already priced in, no surprise.
But if it comes in way hotter, like 300,000 jobs.
Now that's a surprise. And crucially, you have to overlay that with Pillar 1, the dominant macro theme. If the big worry is inflation,
Then that super strong jobs number is actually bad news because it suggests the economy is overheating.
precisely, and that changes the market's expectation for Pillar 2, monetary policy. It signals the Fed might have to hike rates more aggressively.
Which tends to hit stocks, especially growth stocks.
Right.
Okay, if that makes sense. So data gives you entry points, but you need the context and the calendar.
You absolutely need the calendar.
Yeah.
Trading blind on a data release day is risky.
Okay. So if central banks handle the short-term mood and liquidity, who's managing the bigger, longer-term structural stuff? That sounds like Pillar 4, fiscal policy.
That's it. Fiscal policy is the government's domain.
Yeah.
Think Washington, Brussels, Beijing. It's about taxing and spending.
Congress, Parliament.
Right. They don't act nearly as often as central banks, maybe only a few big moves a year or even less. But when they do act,
It's usually big.
it can be huge. Think massive infrastructure spending bills that boost growth and demand for commodities for years.
Or major tax cuts that completely shift investor sentiment. Tariffs, subsidies.
All of that. These things can alter entire industries and create trends that last for decades. The challenge here, though, is often timing.
How so?
Well, fiscal policy often gets priced by the market way before the effects actually hit the real economy. Think about after an election promises big spending.
Sentiment might jump immediately.
Right, investors get optimistic. But the actual dollars from that infrastructure bill might not start flowing and boosting GDP for another 2 or 3 years. So fiscal policy sort of builds the long-term foundation that the short-term data and monetary policy react against. 3. Connections and unpredictable shocks.
All right, moving beyond policy now, let's look at how all these different markets actually connect or talk to each other. This next one, Pillar 5. Intermarket analysis feels like a big unlock for a lot of traders. It's not always intuitive.
Definitely less intuitive, but so powerful. The core idea is simple, really. Markets do not move in isolation. Everything is connected.
Stocks, bonds, currencies, commodities.
They all influence each other. You really can't analyze stocks properly without looking at what bonds are doing. You can't trade the dollar effectively without considering gold or oil prices.
Okay, walk us through a typical chain reaction. Let's say inflation fears are rising, the Fed's sounding hawkish. Where does that ripple start?
Good example. It often starts in the bond market. Rising inflation worries or expectations of Fed hikes push bond yields higher.
Okay, yields up.
Now, higher bond yields increase the cost of borrowing money for everyone. And that tends to hurt companies whose valuations rely heavily on profits expected way out in the future.
Like high-growth tech stocks.
Exactly. So rising yields often lead to sell-offs in tech, maybe the broader equity market too. Then that feeling of risk-off, that nervousness.
Sends investors looking for safety.
Right. And where do they often run? To perceived safe havens like U.S. Treasuries, paradoxically pushing those yields down temporarily sometimes, but also boosting the U.S. dollar.
Wow, okay. So you've got bonds, stocks, and the dollar all moving in a sequence triggered by that initial inflation Fed signal.
That's a classic intermarket relationship. And spotting these connections helps you anticipate momentum. You see oil prices rallying strongly.
You start thinking about commodity currencies like the Canadian dollar, the Norwegian krone.
Exactly. They're likely to benefit. Or if you see gold breaking out and the dollar weakening simultaneously.
Suddenly, a long trade on the euro-dollar pair looks much more attractive because you've got multiple confirming signals.
You got tailwinds from different markets aligning.
Yeah.
That's intermarket analysis in action.
Okay, that makes sense. Now for something completely different. Pillar 6, geopolitics, the wild card.
That's a good way to put it. This is the stuff you can't model, you can't really forecast reliably. Wars, coups, surprise election results, sanctions.
Black swan events, almost.
Sometimes. They inject sudden, often intense uncertainty and volatility into the system.
You can't predict when a conflict will break out, obviously, but you have to recognize the market impact the second it happens.
Absolutely. Geopolitics often triggers a fundamental shift in market psychology. It injects raw fear.
So the focus snaps away from economic data or Fed forecasts.
And shifts entirely to risk management. Pure capital preservation. We saw that so clearly with the Russia-Ukraine conflict in early 2022.
Oh yeah, commodity prices went vertical overnight.
Wheat, natural gas, nickel,
Mm.
huge spikes. Not because of a scheduled data release or a central bank meeting, but purely because of the sudden, massive risk to global supply chains.
And in those kinds of environments, the market stops trying to calculate fair value for things.
Pretty much. The priority becomes avoiding big losses. Volatility explodes, risk appetite evaporates, and correlations can break down unexpectedly. It changes the whole game board, instantly. Psychology and physical reality.
Okay, so we've covered the big picture, the policy, the data, the connections, the chaos. Now let's get into the actual mechanics and timing. Pillar 7, technicals and positioning.
Right. Technical analysis, looking at charts, support levels, resistance, trend lines, that tells you when might be a good time to enter or exit a trade. It helps with timing.
But you mentioned positioning as a crucial second layer here. This always felt like, I don't know, the dark art of trading to me, trying to figure out what everyone else is doing.
It can feel like that, but it's becoming more transparent, more quantifiable. Positioning is all about understanding where the crowd is concentrated, where are the potential pain points.
Pain points, meaning where a lot of people might have their stop-loss orders clustered.
Exactly. It reveals where the market is vulnerable. If almost everyone is betting heavily in one direction, that trade is crowded.
And how do you actually see that? Where do you look for this positioning information?
There are several tools. You can look at sentiment surveys, see if everyone's overwhelmingly bullish or bearish, and there's official data, like the CFTC reports.
Commitment of traders.
Yeah, that shows the positions held by large speculators, hedge funds, institutions in the futures markets. It gives you a sense of how the big money is leaning.
So knowing how crowded a trade is tells you
Yeah.
what? Its potential fragility.
Its vulnerability to a squeeze. Imagine everyone is short the dollar, betting it will fall. Then maybe some unexpected positive U.S. news hits. The dollar ticks up just a little bit.
And starts triggering all those short covering stop orders.
Exactly. Those traders are forced to buy back dollars to close their losing shorts, which pushes the dollar up even faster, triggering more stops. It becomes a cascade.
A short squeeze, vicious, and it might have nothing to do with the underlying economic fundamentals at that moment.
Often it doesn't. It's purely about market mechanics and crowded positioning unwinding violently. So technicals give you the map, but positioning helps you understand the mindset, the potential stress points of the other travelers using that map. It helps you ask, is this current move real, or is the market just leaning too far one way and about to snap back?
Fascinating. Okay, final pillar. Pillar 8. Supply and demand. This sounds basic. Like Econ 101.
It is basic, fundamentally.
Yeah.
But don't underestimate its power, especially in commodity markets.
Because these are physical things. You can't just print more oil or copper.
Precisely. These are real assets, physical markets. Central banks can't stimulate more rainfall or print more copper ore. When there's a genuine physical shortage or a major disruption to supply,
Like weather or war or logistical nightmares.
prices can react incredibly fast and aggressively, regardless of what the Fed is doing or what the latest GDP print said. Think about a severe drought hitting Brazil's coffee region.
Coffee prices could double almost overnight.
Easily, because the physical supply just isn't there to meet demand. Or think about disruptions to oil pipelines or shipping lanes.
The key reminder here, then, is that sometimes the market doesn't give a damn about the macro narrative or the technical chart pattern.
Sometimes it just boils down to, is there enough physical stuff to go around? Not enough copper for electrification. Not enough natural gas for winter heating. Price has to react to that physical reality. Sometimes that's the only driver that matters.
Okay, so we've laid out these 8 lenses. Macro themes, monetary policy, data, fiscal policy, intermarket, geopolitics, text positioning, and supply demand. That's a lot to track.
It is, and here's probably the most critical takeaway of all. These 8 drivers do not matter equally all the time they rotate.
So the real edge isn't just knowing the 8 pillars exist.
No, the edge comes from correctly identifying which pillar, or maybe combination of pillars, is dominating the market narrative right now. Which one is in the driver's seat today, this week?
So you have to prioritize, like if inflation is stable and growth is steady, maybe in a low volatility period.
Then maybe economic data surprises, Pillar 3, and technical setups, Pillar 7, become more important for short-term moves.
But if suddenly inflation spikes or a war breaks out,
Then the dominant driver shifts immediately. Macro themes, Pillar 1, or geopolitics, Pillar 6, can completely take over and dictate everything else.
Let's bring back that 60-40 portfolio example from 2021-2022. That really illustrates this rotation, doesn't it?
Perfectly. For decades, that inverse relationship between stocks and bonds, a key intermarket analysis assumption, Pillar 5, generally held true. It was like financial bedrock.
Buy bonds when stocks fall and vice versa.
Right. But then, runaway inflation became the single, overwhelming global macro theme, Pillar 1.
And that dominant theme forced the hand of monetary policy, Pillar 2. Central banks had to hike rates aggressively.
Aggressively. And those rapid rate hikes were poison for both asset classes simultaneously. Higher rates crushed the present value of future bond payments and killed the growth outlook and discount rates used for valuing stocks.
So the very force driving bonds down was also driving stocks down.
Exactly. They crashed together because they were both reacting negatively to the same overwhelming driver. High inflation forcing high interest rates. That one dominant pillar completely overrode decades of correlation assumptions.
Wow. That really drives home the point. One powerful driver can just rewrite the playbook.
It taught a very loud, very expensive lesson to many investors. You have to know what's actually moving the market.
So it's not just about knowing what happened in the market yesterday?
No, it's about understanding why it happened, which pillar was responsible. Because that understanding is what allows you to start anticipating what the market might care about next.
When you know the why, you can start reading the map instead of just guessing where the road goes.
That's the goal.
Mm-hmm.
Identify the dominant driver. Apply these 8 lenses consistently. You'll start to see the underlying rhythm beneath the daily noise. You stop just reacting to headlines and start anticipating the next fundamental shift.
Thank you for joining us for this deep dive into the 8 pillars of market movement. Really insightful stuff.
We appreciate you tuning in. Join us again on the Financial Source podcast as we actually break down each of these drivers layer by layer in upcoming deep dives.